2024 was an amazing year and far better than most economists predicted. The year started with fears about inflation, the Magnificent Seven stocks at super high valuations, and the uncertainty that always comes in an election year. With such robust performance for the stock market in 2023 and 2024, we believe that the margin for error in financial markets is very slim in 2025. With equities largely priced to perfection, discretion will be of paramount importance in pursuing opportunities, but also in managing risk. As it turned out, we had only one meaningful pullback in late July of 2024, and the market continued its steady march higher. The pullback in late July, early August, lasted only a few days before the market continued its climb. As a result, our portfolios performed very well in 2024. This is great news, but I know that some folks will be frustrated by the tax implications. After 2 years of the market consistently reaching all-time highs, even strategies such as loss harvesting provide very little relief. As investors, we must follow the most basic rules of investing, namely, buy low and sell high. You've heard me say this many times, and the result is that our rebalancing throughout the year, in most cases, triggered some capital gains instead of losses. This is necessary in order to manage risk when a portfolio continues to grow. The end result is that you shouldn't be surprised by some potentially higher taxes this year. But the good news is that you will owe taxes because you made money. Think of it this way. Would you ever tell your boss to not give you a raise or to not pay you a bonus just because of the taxes that are going to happen as a result of it? Similarly, your investments performed very well last year, resulting in some added taxes. At times like this, it's okay to let your investments pay their own taxes. So, if you need to make a withdrawal at tax time to help pay the taxes, please don't hesitate to call the office and allow us to free up some cash to help pay for the taxes. After all, if your investments cause taxes, they should be responsible to pay the taxes as well. Another major factor in 2024 was the presidential election. Once again, our elections reveal that our nation is split over the best way to solve problems that confront the United States. But please don't feel that a president has the ability to unduly influence the economy or the markets. Here's a chart that shows the performance of the market over the past 80 years. As this chart shows, while the stock market has fluctuated under presidents of both terms, the S&P 500 has trended higher over the long term, no matter who's sitting in the Oval Office. Over the past 80 years, the stock market, as represented by the S&P 500, has advanced under every administration. Second, the stock market has generally trended higher over the long term, regardless of which party holds the presidency. And third, the dynamic U.S. economy has consistently produced successful companies contributing to economic strength under various administrations. As my mentor in the financial services industry taught me back in 1987, there has never been a stronger economic engine on earth than the American economy. He warned me never to bet against the American innovation, entrepreneurialism, and a drive to succeed. Fourth, factors like earnings growth, economic conditions, and technological advancements can have more influence on market performance than political changes. Fifth, your investment strategy should align with your goals, your time horizon, and your risk tolerance, not the outcome of a single election. What about going forward? Well, we're optimistic about 2025, although that view is tempered by a healthy dose of caution. Our investment management team believes that while there continues to be great opportunity, there are also multiple uncertainties that could determine how the economy and markets perform next year. However, strongly believe that active management will be the key to successful investing, and markets will likely continue to rise and broaden in 2025. The election of Donald Trump, with his proposed policies including tariffs, tax cuts, and deregulation, complicates our predictions about 2025. It looks like it's going to be a pro-market, pro-business administration on the upside. But on the downside, there are the tariffs and the risk of higher costs. And if the economy heats up too much, causing inflation, then the Fed will need to raise interest rates, which will put a real brake on things. So what are we expecting in the coming year? The market jumped in the days following the election. And at that time, I stated that I thought much of the movement was based on emotion, not meaningful data. I also thought that the emotion would work its way out of the system and that the market would come back in. It seems that the last couple of weeks of December followed that pattern. I believe that the economy remains very healthy. It's hard to find too much data that points towards a recession anytime soon. For the past 2 years, the market has been concentrated in the largest stocks, sometimes referred to as the Magnificent Seven. But we're seeing that the market is broadening, and that's a very good sign. One of the biggest questions on investors' minds is, can stocks extend their strong performance? The environment remains positive for U.S. equities. They've been resilient, notwithstanding rising interest rates since September. There have been geopolitical tensions and a lot of other things that cause people to worry, but stocks haven't faltered. That tells me that the underlying market structure remains pretty strong. But valuations remain very high. How long can that go? Well, the most important thing to watch for regarding the direction of the market is not just earnings, but whether earnings are accelerating or slowing. For almost 2 years, we've seen not only strong earnings, but we've seen accelerating earnings growth as well. However, in the fourth quarter of 2024, earnings growth began to decelerate. This is something that we will need to keep an eye on in 2025. What about the other 493 equities that aren't the Magnificent Seven? Finance textbooks tell us that investors should diversify their investments, but there's little diversification today when buying the S&P 500. The combined weight of stocks with a weight of 3% or more in the S&P 500 index is at an all-time high and continues to rise. The bottom line is that buying the S&P 500 gives the impression that you're buying 500 different stocks and diversifying your investments. But the reality is that the high and growing concentration in the S&P 500 continues to be a major problem. In short, investors should ensure that their portfolio is not all levered to NVIDIA earnings. We fully expect that the stock market also will continue to broaden, focusing less on the Magnificent Seven tech stocks. We really started to see the other 493 stocks start to perform in the second half of 2024. Equal-weighted indexes have become more competitive against market cap-weighted indexes. And in our opinion, valuations are attractive for these smaller stocks. But which stocks? Small cap equities, both growth and value, were left behind during the rush of the mega cap stocks and now look quite attractive. Small and mid caps tend to perform well during a credit easing cycle and not so well in a tightening cycle. Therefore, the tailwinds are at your back here in terms of small and mid-sized companies, if the expectations are that the Federal Reserve will continue cutting interest rates in 2025. A big story at the beginning of the year was inflation. Although inflation has become less of a threat than it was 2 years ago, we question whether it's been fully tamed. While the Federal Reserve has prevented a recessionary hard landing, it may not be able to bring inflation down to its target of 2%. A year ago, economists and strategists argued about whether we would see a hard landing versus a soft landing. Now the question on everyone's mind is, will we see a soft landing or no landing at all? We're skeptical that the Fed will achieve its 2% inflation target. It doesn't seem like inflation will keep falling. We're seeing some stickiness in services, food, rents, and other basic necessities. So there is evidence that inflation could reignite like it did in the 1970s. This chart overlays current inflation since 2014 to 2024 in green over 1966 to 1977 in blue. Could we experience a second mountain of inflation like we experienced in the 1970s? I don't know, but it's certainly something that we need to keep our eye on. Recent inflation readings show signs that the decline in inflation has stalled, and there is a risk of reacceleration. The Fed and market-implied measures of inflation are all above the Fed's 2% target and not showing signs of moving down toward the 2% target. Short-run and long-run inflation expectations are also moving higher. And there's recent uptrend combined with strong economic momentum. It's pointing towards a rebound in inflation in 2025. And it's not a soft landing to justify Fed rate cuts. The probability is rising that the Fed may have to raise rates in 2025. What's the most important thing to note is that a portfolio comprised of stocks and bonds has historically kept ahead of inflation. For retirees, this is critical, since as this chart indicates, it now takes $18 to purchase what $1 back in 1926. Let me summarize a few of the risks that I see going into 2025. Here's a chart that lists 7 of the risks in my personal probability estimate bell curve, along with the implications. The biggest threat that I see is tariffs. I think there's about a 90% probability that we will see tariffs, and that could slow down global trade, resulting in a slowdown in the economy. The second concern is NVIDIA earnings could disappoint expectations. I give that an 85% chance. NVIDIA is now almost 7% of the S&P 500 index, so its performance makes a big difference. A third risk is that the U.S. economy reaccelerates. I give that an 80% probability. The implication is that an overheated economy could cause rising inflation, which in turn could cause interest rates to rise. A similar risk that I see is that inflation doesn't slow to the Fed's 2% target, but rises instead. I give that about a 50% probability. And the implication is this would force the Fed to raise interest rates, which would cause the market to slow down. The result of such a thing is another risk, and that's that the Fed would raise interest rates in the third or fourth quarter. I give that about a 50% probability. And the implication is that rising interest rates are a headwind to both bonds and stocks. Could this be a 2022 repeat again where both stocks and bonds were negative? Another risk is that there's a recession in Europe or China. You get that about a 35% probability, and that would hurt because of a global economic slowdown. The last risk is that the U.S. goes into a recession. They don't give that much probability at all. Let me wrap up my comments with a summary of how we have our portfolio's position going into 2025. While I remain optimistic about the economy, I can't ignore the threats that I just listed. As a result, we have deliberately made changes throughout 2024 to prepare for any dislocations that we may see in the market in 2025. Historically, our portfolios included significant holdings with active management who could make tactical decisions on a daily basis to complement our asset allocation strategies. For a couple of years, we focused on less expensive index and ETF strategies but I feel strongly that active management will help us to outperform in the future. In addition, we've added back about 20% in alternative assets that zig when the market sags. Simply put, we deliberately added investments with low correlation to stocks and bonds. Things like precious metals, commodities, tactical trading strategies. These add both diversification and alpha to our portfolios. You've heard me say that adding alpha is like adding octane to your fuel. It will help our portfolios perform better. I'm very pleased with the team who's helping me to manage the portfolios and to meet with our clients and to implement these strategies, which have proven well over the test of time. I believe that we're delivering the best portfolios that I have in my career, and we are well situated for whatever arises in 2025. As always, thank you for the trust and confidence that you placed in me and my team. We look forward to serving you in 2025, and don't hesitate to give us a call if you have any questions.